Hi, everybody. I just wanted to say hello and thank you so much for taking this Thursday morning to be here with us today. So, just a really quick thing. I am actually in a hospital in a waiting room, so that's why you might hear some sounds. My husband was taken into surgery, and the reason I didn't cancel is because I'm sure you've all been there. It's better to be working and keeping your mind occupied than sitting and waiting until they come out of surgery. So, just so you guys know, if by any chance there's an interruption in internet or there's a sound, I am literally hiding out in the quietest section and I didn't want to cancel. So I'm actually really grateful to be here and to be able to attend this because it really helps with, you know, the waiting, which I'm sure you all know. So I do just want to say that I am here giving a presentation, but the goal for me really is to help you guys. The fact that you guys are here joining us for this summit shows me that you have maybe questions or challenges. I understand that you want to learn more, and I get that 100%. But I always also say that day trading and investing, they are not spectator sports. So for you to ask me questions, that would be the best way for you to learn. So I would love for you guys to just ask me as many questions as you can. I promise to get to all of your questions. And on top of that, I truly hope that you will learn at least one thing. I always say if you get one thing out of any presentation, any book, anything that you are trying to learn from, that one thing can make all of the difference. So whatever your one thing is, I truly hope that you get it from me today. And I am here to help you. So remember, please send me your questions. I am excited to present. And let's begin. I am Marina, the Trader Chick, and today I want to talk to you guys about understanding the power of the breakout trade. Because the breakout trades, they are truly some of the most powerful trades that we could possibly have. But if you miss out on a lot of the little things, you might not be able to know when that breakout trade really happens, right? And that's the most important thing is spotting them, knowing when they're occurring, understanding how they are going to occur. So that's the goal of my presentation today. So here's just a really quick intro. I am Marina, the Trader Chick, and that is me. And what I want to cover today is understanding market movements. Okay, that's super important. Understanding indicators for those entries and the profits and how to really identify that breakout trade. Okay, so as I said, I am Marina, the Trader Chick. I actually am an expat living in Antigua, Guatemala. That's me with my two sons. And before I became a day trader, I was a fitness instructor. And and also a travel writer. And why do I say this? Because a lot of times people think that you have to come from a financial background or math background or even like an engineering, mathematical sort of a background. And that's totally untrue, right? Because I was a fitness instructor. I still am actually a travel writer. So a lot of times having any kind of background really is the essence of you becoming a good trader. And on top of that, I'm also trilingual. And the main reason I bring up being trilingual is not because of, oh, how cool you to speak three languages, but because I had the advantage of learning a third language in my later years. I learned Spanish when I was in my mid 20s, and anyone who has ever learned another language in their later years knows that it's a process. For instance, I was born in the Soviet Union, so I speak Russian fluently. But I migrated, I was a refugee to the United States, and I learned English when I was really small, but I learned it really quickly. I didn't even realize I was learning, and within 3 to 6 months, I was fluent. However, Spanish, I learned in my late 20s, and that was an entire process. And when I began trading, for years I struggled. I struggled. I was following people's patterns and entries, and I was failing until I looked at it from a different angle. They always say shift your perception, and that's when magic happens. And I shifted my perception and started to look at the market and the charts as if though they spoke a certain language. And that's when I realized that it is literally like learning a new language. And that's what I want to show you guys, the basics of the market language, because I can guarantee that will elevate your trading to a whole new level. And obviously the coolest thing about day trading is that you can do it from anywhere. I mean, look at me right now. I'm hiding out in a hospital waiting room, able to present for you guys. And then I'm going to be taking the time and also looking at the charts and really focusing and trading as well. I'm not sure if I could trade live because my mind is obviously on my husband's surgery, but I'm going to be sitting here and watching the charts because I enjoy that. And I could do that from anywhere in the world. And before COVID, I used to do a lot of live presentations at Money, showed the Traders Expo. So now I really enjoy doing the virtual ones more, simply because a lot more people are able to attend and I could reach a lot more people and help a lot more people. So let's begin. Here's the thing, guys. When you learn a new language, there are basics, right? I'm not about to enter into a conversation with 6 Spanish speakers who are ongoing in a really big conversation without knowing anything, right? I will be completely, first of all, they'll be looking at me like, who is this person? And I will be completely lost and I would feel really low about myself, right? So I would start the conversation one-on-one. My name is Marina, you know, the color, what colors do you like? Things like that, basics. And a lot of times what people do when they begin trading is they just jump right in without having those basics, like getting into the car. Today, a lot of us are driving cars, but we forget that when we first sat down in the car, we needed to know where is first gear, where is the clutch, where is the brake, where is the accelerator. Those are the basics, right? Where is the steering wheel? We forget that because today we just hop in and go. But that's not how it works. You need to first learn the basics. And that's exactly the same thing with the market. So everything I am going to be talking to you guys about today, I have a presentation, a worksheet that I have worked out for you, 100% free. Go to makingofadaytrader.com, and Anna always posts the replays of these presentations. So with this worksheet, you could then go back and go over it a little bit slower, and it really is helpful. So go back, grab my worksheet at makingofadaytrader.com. It's completely free, and you will be able to go along with a presentation. All right. So let's get back to those basics. Let's build that foundation, because I see so many people putting in windows before they have put in those walls to hold up those windows, and those windows keep on crashing. And you guys know exactly what I am talking about. All right. So what are these basics? Before you go anywhere, you cannot be a trader or, a strong, even swing trader if you don't have a chart. You cannot be a Formula One driver in a minivan. You need a strong charting platform, whatever that is. And today there's so many platforms out there. And indicators. The best platforms, they give you free universal indicators. So make sure that you guys use the proper indicators. I get so many students that come to me and they're like, oh, I have these 10 indicators and do you use this one? Do you use that one? And I'm like, okay, so you have 10 indicators. Well, why do you have each indicator? Oh, well, this guru said to use this one and this YouTuber said to use that one. I'm like, great. It might work for them, but is it working for you? So what I recommend is going to each indicator and really focusing on it and using it and seeing if it makes sense to you. Just because somebody said it works for them does not mean it's going to work for you. At the end of the day, for me, after going through 10 indicators, I'm now down to 2 indicators, because these are the 2 indicators that work best for me. And I like to simplify my trading. Okay, so remember, everything I'm going to be going over, makingofadaytrader.com. You can download this presentation worksheet there. All right, guys, let's begin. Okay, let's understand the market movement. This is so, so important. We all understand that there are 3. Oops, hang on just one second here. We understand that there are 3. Oops, sorry, there we go. I just totally misplaced what I was doing. Okay, there are 3 trends to work with, right? three trends. We all understand about the upward trend. We all understand about the downward trend, but do we logistically and really understand the sideways trend? Why is this important? Because the sideways trend, this is where the majority of our losses go, right? And this is also where you could benefit from that breakout zone. So understanding and spotting and drawing out that sideways trend is going to completely change everything you do, right? We understand the downward trend, upward trend, understand and really draw out that sideways trend. And that's what I want to talk to you guys about today, because that's where those breakout trades work from. Okay, so just a quick recap. What is an upward trend? Each pivot is higher than the next. Pretty basic stuff, right? We are moving upward. It's the upward trend. That's the upward trend. It's the bull market. It's the market trending up. So this is also where you buy. This is where you go long. This is when you enter at a lower price point, exit at a higher price point, and you take that profit in between. Very, very important to understand. This is where you're going long. If you don't understand the difference between going long and going short, you need to stop everything and learn the difference with those two, because it will be all the difference, because you could be entering on a short when you want to go on a long, and what's going to happen, you're going to be filled on your stop rather than your profit target, right? So this is going long, buying. What is a downward trend? It's literally the opposite. It's each pivot is lower than the next pivot. The market is going down, right? You are entering that short position. You are going in a higher price point, exiting at a lower price point, and you're taking that profit in between. So important. You are selling. You are going short. This is what it looks like when you're entering the market. It is a bear market, a market trending down. Right now, with a market that has just been panic mode, going straight down, there is a lot of traders making a ton of money shorting the market. And you can too, if you understand the difference. Okay, so how do we recognize these areas? As I said before, the sideways market, the consolidation area, transition area, these are the trader's worst enemy, and you need to spot them and you need to avoid them. This is called the exhaustion pattern, the indecision zone, the chop. I don't care what you call it. You need to understand it. Every charting platform, I don't care if it's the cheapest, the lowest, free, whatever, they all have drawing tools, even if it's something as basic as a line to draw in so that you recognize where are these consolidating areas. What is a consolidating area? It's an indecision zone. It's an area where it's total uncertainty. Do you really want to put your money into an area that is bouncing back and forth between two areas without having any real movement, any real flow? Absolutely not, guys. Do you really want to be trying to beat the market when it looks like this? No, because you don't know if it's going to break out or if it's going to transition into a whole new trend. So what do? This is when you do one of the three most important moves of a trader. You either get in, know when to get in, know when to get out, and most importantly of all, and the least used, is knowing when to stay out entirely. That means knowing when to sit out and not put any money in at all. Okay, this is when you really have no idea, when you see something like this, a consolidating market like this, when it's going to completely shift and into a whole new trend or breakout. And I'll go into a breakout in just a little bit. Okay, even when you have these mini consolidation areas, because it could totally stop you out before it breaks out. All right, and they happen all the time. As you can see here, we have a channel, breakout, boom, beautiful entry, another consolidation, breakout, boom. This is what we need to understand. You see here, this is not where you want to go in between these two areas. You need to draw them out. And we're going to talk about these two areas in just a little bit. But look at this massive, beautiful breakout. If you don't have it drawn in, how are you going to be able to understand when it happens? Okay, know your areas. Look, guys, the market respects areas. And we, as the individual trader, as the retail trader, we have to understand these areas and stay out of these areas. What are these areas? Support and resistance. I want to tell you what support and resistance is so you guys really understand how important they are. Okay, and Formula One drivers, it is a known fact that 25% of the Formula One drivers during racing season either have a massive accident or even worse, a fatality. So when they enter their car, what is going on? They have their safety gear on, right? They have their helmet on, they have their seatbelt on, they even have a fireproof uniform on because they protect themselves. Here's another fact: 95% of traders fail. Why? Because they don't know what they're doing the majority of the times, and they certainly don't have their safety gear in place. What is their safety gear? Besides putting in a stop loss, and I'm not talking about a mental stop, guys, because mental stops are as useless as putting on a mental seatbelt on your baby when you're driving and thinking you're going to save that kid in an accident. And the other thing that the people do is they put in mental support and resistance areas. Guys, support and resistance areas are as important as having your seatbelts on. What does that mean? It means you protect yourself because support and resistance areas are revisited. And do you really want to be going into a support and resistance area? It does not matter how strong the market looks. If the market is respecting it, you will be stopped out. So let's focus on understanding support and resistance areas because they are so important. What is a resistance area? It is literally the ceiling of the market. It is literally a place where the market is hitting 3 or 4 or more times, and chances are stopping strong upward trends. It is the ceiling of the market, and you have to have it drawn in because it tells you in the future if it's going to revisit that area, and it protects you from entering into those areas. Okay, I cannot stand when people tell me, oh, I just put it in mentally. When you are in the live market with your live money on the line, your adrenaline is pumping through the roof. You are not going to remember what you put in mentally. You need to draw these out. What is a support area? Support area is the floor of the market. It is a downward trend that is hit 3 or 4 more times, and it is an important area. You need to understand these areas, guys. You need to understand support and resistance areas, and you need to draw them in so that you are prepared for what is happening in the future, so you protect yourselves. Okay, it is important. Like I said, any charting software, it gives you this capability of drawing it in. I don't care if you use rectangles, lines, whatever, just draw them in. Now you can put in those consolidating areas because you have the understanding what is a resistance area and a support area. And you never want to be in a market that looks this crappy, bouncing between these two areas. Does this look like something that you want to put your hard-earned money into? Absolutely not. But you don't realize that until you have them drawn in. Because right now it looks really obvious because I have my areas drawn in. But trust me when I tell you this, it's not as obvious as you think. Okay, so make sure you draw these areas in, and they could be wide channels or small ones. And again, you want to protect yourselves. It's all about having that edge. You want to be protected, right? You want to hedge the market. What do you think a hedge is, guys? It's protecting yourselves. It's having that edge on the market. Now, how do we spot these areas before it's too late? And that is reversal areas with divergences, I should say. What are reversal patterns? Double bottoms, double tops, triple bottoms, triple tops, head and shoulders. These are the most beautiful free shifts in traders map that you could have free signals for you. You do not need to pay fancy algorithms and softwares. It's all right there. And these are probably the strongest indicators you're going to have, and they can be done on any charting software with any instrument that you trade. This is a triple bottom, a triple top. It is not telling me 100% it's going to shift. What it is telling me that it is a very high potential for a reversal pattern. Very high potential, okay? But again, you need to draw these in. So what is a divergence? Divergence is one of my absolute favorite things. As you can see here, my price action is showing me that it is going up. Yet I use the MACDs, which is the least lagging indicator, and it's showing me here that it is going down. What is that telling me? That the market is losing its strength, and I need to sit out and wait this out. Okay, double bottoms. When you see reversal patterns with divergence, this is the absolute most indicator, I guess you could say, of showing you when there could be a weakening in the market, or even better, a transition in the market. Okay, these are the absolute best, and like I said, you could do them on any platform, any any instrument of the market. Okay, this is how you guys can spot them. Now, let's put this all together. And remember, like I said, everything I'm saying to you right now, you can get 100% free in right here in my worksheet that I made for you, makingofadaytrader.com. Makingofadaytrader.com. All right. Now, let's put this all together. What is breaking out of an area? How do we spot these breakouts? So here's a breakout, right? I have my resistance area drawn in, and then boom, it breaks out. So let me explain it to you in layman's terms. Imagine that you live here, right? And your friend lives north of you, and you have to take a highway to get to your friend's house. And you've been in this highway 1,000 times. You get on that highway, you're driving north, but all of a sudden there's a huge construction site and a huge detour, and you have to get off. So I don't know about you guys, but I start to stress out because it's super uncertain. What if they stop with the detour signs? I don't know where I'm going. Google Maps and Waze hasn't caught up yet. What if I get lost? There's all these what ifs. What if, what if? But all of a sudden, the construction worker says, you know what? It's all fixed, guys. You could get back on the highway and head back up. And what are you going to do? You're going to press on that accelerator because you're totally back in that confidence zone. That is the breakout trade. You're going up. Oh my God, detour. I don't know where I'm going. Oh, what if they stop with the detours? I don't know this area. What if they tell me no? Oh, boom, you're back on the highway. Breakout trade. That is the breakout, guys. That's how you spot it. But without having these areas drawn in, you are never going to be able to spot it and understand the breakout trade. So how do I use the breakout trade? So I mentioned earlier, I use two indicators, right? I only have two indicators. I have my MACDs, which they are my holy grail indicator. I do not do anything without them. They show the most amount of when it's strength, when it loses strength, when it changes. And I use three EMA lines. I use the 20, 52, and the 135 EMA line. I have them all here. So I use my EMA lines from where I take my trades, because you never want to enter as a market trade, right? Because if you're entering as a market trade, that means you're just going in wherever you want at that moment, impulsively, hastily. You're telling the market, you know what, I'm a total amateur. You could totally, take my money. Because when you enter a market, you immediately get slippage. Slippage is 25% of your entry immediately taken away from you. All right. So you don't ever want to do that. You want to put in your limit orders. You want to tell the market where you want to enter the market. That's how I use my EMA lines. It's kind of like an archer. Archers never walk around aimlessly. They have a very specific spot where they shoot their arrows from. Professional traders do the same. Okay, I just want to do another really quick trade setup using these areas, because now I get to utilize the resistance and support areas that much more. Okay, and that is called the initial instant reaction trade. It's when the market changes and transitions into a new trend, right? Because when the new trend is one of the strongest places to enter, because this is like when the trend has the most amount of energy, you could enter that trend and boom, this is where you could go the furthest and make the most amount of money. All right, remember guys, everything I'm showing you here, makingofadaytrader.com. Now, I just want to do a really quick live market analysis. Ooh, hang on a second. There we go. So that you guys could understand how I use my charts. So this is my chart right here. And as you can see here, we have a pretty significant resistance support area, right? So let me draw this in for you here so you guys see how I use it right here, okay? I am automatically shown that this is a really strong area. But I also want to show you something interesting because right here, I had a significant resistance area. And look here, I'm going up. I have this massive resistance area right here, right? And then boom, I have this beautiful breakout area until it hits it again. And now I'm channeling once more. And as you can see here, this is setting up to be a breakout trade. But I like to have my areas drawn in, and I also like to keep myself protected. I have a very strong strategy when I use one of my EMA lines to pass through. Otherwise, what could happen? You could have a fake out breakout. A lot of times, fake out breakouts is where a lot of people lose their money. Okay, so you want to have a very strong strategy to protect yourself from that. And I like to see my 20 EMA, which is this blue dotted EMA past the breakout zone so that I have that much more confidence in entering. And look at how far my MACDs are. So this is all showing me that there is a very high potential for a trade setting up. But until this crosses over, it could simply be a fake out breakout situation. And you don't want to be in a fake out breakout situation. You want to protect yourselves. Okay? So hopefully that makes a little bit more sense for you guys. Okay, so here's the thing, guys. We have everything that we need to take action. Everything, right? We have these presentations, we have YouTubers, we have books that we could read. But but at the end of the day, after we have spent time on the charts, how do we know that we are actually doing it right? How do we know we're doing it right? All of this is great, right? But the real question is how do I even truly get started? Yes, you've been trying and it hasn't been really working, but how do you really get started? And this isn't only a question I get from beginners. I get this from seasoned traders who have been trading for ages but are still inconsistent. They ask me, what can I do to turn this around? What can I do to be profitable consistently? And a lot of times it's literally just lacking these understanding of these basics that we went over, right? Like I said, it's the basics that when you're learning a new question, a new language that could truly propel you to the next level. But when you don't have those basics, you're just putting in those windows without those walls and they keep on crashing. Just like with a car, when we first get into the car, we don't realize, but we don't really know where is the accelerator, where is the clutch, do we have to remove the clutch when we press on the brake? Where is the gear? You cannot change gears without releasing the clutch or pressing on the clutch. These are all basics that today we hop in and we just know it. Okay, so that is crucial. And people don't realize that, but if you've never entered a car before, and you get in the car and the driver is like, all right, buckle up, this is going to save your life, and you've never been in a car and you're like, buckle up, what is that? If you've never seen a seatbelt, how do you know that this is the apparatus that could save your life? And instead it just starts to stress you out. These are the things that we need to have in place to protect ourselves, and those are the basics. And here's the reality of my own truth. I spent over $20,000 on my own trainings, and I was in different trade rooms and different academies, but whenever I asked the basic questions, I was either ignored or treated like I was born with this information, but nobody actually teaches this to you. And I struggled for years and lost money for years to the point where I ended up losing almost $4,000 in 5 minutes. And that's when I just couldn't take it anymore and I quit. But here's the thing, guys. A majority of you who are sitting here with me today is we are all bit by the trading bug. We are bit by the trading bug. What does that mean? It means that it never stops itching. And why is that? Because deep down inside, we know that we can do this. We know that we could do this. If others are doing this, what is keeping me apart from them? That's what kept me going. And that's when I decided to get back to the basics. I literally had 3 monitors. I'm not even exaggerating, guys. I had 3 monitors. I had over 10 indicators. I was in constant analysis paralysis because the majority of indicators I didn't understand. I was always all over the place. So after I quit for like 4 months, but I couldn't stay away. I came back and I literally donated 2 monitors. Well, I put them out for my garbage men to take, and they were almost new. They were less than a year old. I removed all of my indicators, and that's when I just realized that 2 of those indicators were the ones that really worked for me. And I started to focus on the basics, everything that I just went over with you guys. And one day, one of my students goes to me, Marina, your teaching is really similar to Coach John Wooden. And I was like, who's Coach John Wooden? And that's when I started to research him. And this guy was a legend. He was absolutely legendary as a basketball coach. And his entire philosophy was when in doubt, get back to the basics. And I mean, this guy has accolades more than we could ever imagine in our lives. He has won 80 national championships, 10 NCAAs. I mean, this guy is incredible. And he worked with the top superstars of basketball. These guys were unbeatable. But guess what? Every time they started a new season, he would start them with the basics. And what does that mean? He would teach them how to tie their shoelace, how to roll up their socks, how to dribble a ball. Because here's the reality, guys. And a lot of you are like, oh, I passed that. I know all these basics. I know how to do all that. But when you overlook the basics, here's what happens. You could be dribbling that ball. You could be in the middle of that basketball game. But if your shoe is untied or not tied properly and it falls off and you twist your ankle, guess what? You're sitting out for the rest of the season. It doesn't matter what you know. It doesn't matter if you're the next Michael Jordan. If you have a bad ankle because you didn't get back to the basics, like I said, you can't be putting in windows when you don't have your walls in. You got to get back to those basics. And here I want to introduce to you right now my introductory course. And this is only for the participants that are here live today. Nobody else gets this access to this introductory course. And you could do this course on any apparatus, your phones, your tablets, desktop, laptop, anywhere. And you get this for $97. One time fee, $97. You could go here for bootcampfordaytrading.com. So let's talk about what can $97 can bring you on bring you a return on your investment. $97. Okay, so can you go and play golf? Well, today, maybe just one person, so you're going to be kind of bored if you want to invite a friend, right? How about taking your friends out for lunch? I went out to lunch the other day, and this is in Guatemala, and it was $50 for me, right? So for $97, I can maybe take me and my husband out for a lunch. So $97 could barely even buy you lunch today. All right, so let me break this down for you guys. Bootcampfordaytrading.com. Let me break this down for you guys today. Here it is. What is included in this $97? First of all, you're going to get the simplifying day trading package. The other thing is I recognize is that the majority of people really struggle with their platforms, right? They just don't understand how to fully set them up, and then they go live and then they're freaking out because they're not understanding what's going on. They're losing money. So I have included in this package a 30-minute pro platform setup tutorial. Does not matter which platform you work with. I will help you get it set up so that you guys don't have to worry about the platform setup and can get into the important stuff, and that's the trading. Then we're going to really get into the anatomy of dissecting those markets, understanding those magic telltale signs, the reversals, the divergences, because guys, this is magic. I'm not even kidding, and it's super easy to understand and recognize. And I have had so many students be like, oh my goodness, I cannot believe I never paid attention to the reversal patterns, but they have changed everything for me. They have become my biggest aha moments. Reversal patterns, divergences, how to spot those areas, understanding the support and resistance areas. This can totally save you guys and really up level your trading and start making you more money rather than you donating that money to the market. And mastering the breakout, finding out the power of that breakout. Because if you don't understand how it works, just like I was showing you before, you could be entering those fake out breakouts and losing money and missing out on the breakouts. We go over all of that in full detail. Okay, and you have unlimited access to this curriculum. All of this is valued at $1,600. Okay, you get all of this valued at $1,600, and that's $97. However, wait and see what else I've got for you guys. And here's some of my testimonials. And I have students from all over the world because that's the beauty of trading, right? We could do it from anywhere in the world. Best money I ever spent. More than once, I thought I understood what I was doing, but I had it all wrong. You are the only mentor that actually checks the work, that works with me. I am so enjoying your boot camp. I am learning every day. So let me share something super important with you guys. Here's the thing. Remember how I asked you, how do you know you're doing it right? Here's one bonus that this is priceless. I am including in that $97. Again, this is one-time fee of $97, 1 month, one-on-one mentorship with me, unlimited feedback, one-on-one mentorship with me. And on top of that, guys, this mentorship thing, that is what's going to take you to the top. And on top of that, I'm saving the best for last, but I also have a live trade chat room that I do weekly where we take live trades, where we implement the market, and it's me. It's not any moderator, not any administrator, it's me, where we work together, and you get 30 days free membership included in this price. All of this is valued at $2,600, but just for you guys, only for the people that are here live, $97. You could go right here, bootcamp4daytrading.com, bootcamp4daytrading.com, bootcamp4daytrading.com. All right, here's what you guys get for that $97. Everything in the course, 30 days one-on-one with me. I mean, that's priceless right there. And you get 30 days live chat room membership live in that. Now, we all know, and come on, this is a reality check. We all know that this alone is worth less than that one trade that you guys usually place during the day. Worth less than the price of one trade. And the cost of this course and all that comes with it will bring you 10 times return on your investment. So you could take out your friends, your family 10 times for this, that one-time fee. But here's the reality. Here's the thing, guys. Because of my one-on-one mentorship, I can only take 25 students, okay? Because I really commit to giving you my full attention. So here it is. You could go here, bootcamp4daytrading.com, and it's going to take you to this order form. And look at this, guys. You could get started with $59, right? A payment plan. This is a no-brainer, guys. No-brainer at all. Bootcamp4daytrading.com, $97. Now, this is a time for you guys to ask me any of your questions. Right now, bootcamp4daytrading.com. So here it is. Hang on a second here. Okay. It's bootcamp4daytrading.com. Okay, and it'll bring you to this order form. Hang on a second. Sorry, my internet here is not super. So it is, hang on a second. Okay, it's not working at the moment the way it should be. And that's because I am in the hospital with their internet. So this is where it's going to be taking you. Hold on a second here. Okay, so this is where you will be going, bootcamp4daytrading.com. So guys, go here. This is where you guys will be able to enter. And again, like I said, you could start $97, one-time fee, includes everything that I just went over. And you could get started with $59. This is a no-brainer, guys. Okay, no-brainer. This is less than one price of one trade. Okay, so let me know if you guys have any questions at all. And I am just grateful that I was able to present for you guys. And hopefully you did learn even that one thing. Remember that one thing, whatever your one thing that you really got out of it, could really, really help you understand. And I look forward to having you in my course, and anything you guys need, this is the time to ask, or you could also write me at the Trader Chick. All right. And thank you, Anna, so much for having me. And thank you so much for putting up with all the technical situations that I had before the presentation went live. All right, guys. Thank you, everybody, and have a great rest of your week.
Good afternoon, everybody. Always a pleasure to be with you on these very special events, and thank you, Anna, for setting them up. It's great to have multiple traders in here to share with you what's working in today's markets. And I want to share with you what's been working with us for a long time in our FANG options trader program, how you can leverage FANG stocks with weekly options. In particular, one of the great things I've been waiting for quite a long time is that Google is about to have a stock split at tomorrow's close, meaning that after tomorrow, we'll see the stock cut down from its current $2,000+ share price down closer to the low 100s per share. And this is very important for option traders because now it really opens you up to a wider range of ways you can participate in Google, whereas maybe you couldn't participate in it before. 100 shares of stock used to cost before tomorrow, it costs a couple $100,000 to control 100 shares. Now you'll be able to do that for a whole lot less, and then with options, control it for even less. We're going to get into that today, and I'm going to share with you how we use weekly options on these FANG names like Google. Just a reminder that the information provided in today's presentation is based on our proprietary research, is intended for illustrative purposes only. These should not be considered specific advisory recommendations. As you know, stock and options trading have large potential rewards, but also large potential risk. The past performance of any trading system or methodology is not necessarily indicative of future results. So do see our terms of use on our bigtrends.com homepage for more information in this regard. With that behind us, if you don't know me, I've been trading for 32 years. Pretty much caught the trading bug when I was at Duke University. Upon graduating there, for most of the 90s, worked as the head of research for the nation's largest options newsletter, then launched bigtrends.com in 1999. So we're on our 23rd year going strong, and love serving tens of thousands of traders all around the world with real-time trade alerts and education on a variety of strategies that can work for you, whether you're a growth aggressive type of trader or whether you're a more income oriented trader. It's something you can take advantage of here. And as I get into the stock split, I do want to ask you to get involved here in the chat. Pop in for me, give me a number of how long you've been trading options. If you're brand new to options, never traded them, type a 0. If you're in your 20th year, type a 20. In your first year, type a 1. It helps me to know kind of what kind of a crowd we have with us, if you've traded options before or not. But I find that, it's one of the reasons that I've been teaching options for 3 decades is that if you're new to options, and don't worry, like Sharon, new to it, that's okay, is that once you understand what we're going to teach you today with like reading the stock correctly, we can come up with really simple, effective stock substitute strategies to learn how to leverage that more intelligently with a lot less capital at risk using an options trade. So people think of options as a speculative thing, but actually it can be a risk management tool in a very big way. Kirk, same thing, new to it, don't worry about it. You'll learn something here. Paul, been trading for more than 10 years. Great to see it. Anna, hey, you can always be learning. I know that it's a powerful thing here. So what we're going to focus on, first of all, let me go back to what is a stock split? Like I said, it's Google is splitting at tomorrow's close 20 for 1. So that means that if you had 1 share of Google stock, in this case, take your typical 100 shares, one option contract controls 100 shares. So if you had 100 shares, it splits 20 for 1. You will now have 2,000 shares, but at 1/20th the price. So technically, if you're a stockholder, this stock split doesn't change the total dollars of value that you own in the stock. But for option traders, it's a huge change because, like I said, if you right now, if you were going to try to trade an option on Google and commit no more than $1,000 per trade that you made, that means you usually have to buy an out of the money option. You have to buy something, if the stock's at 2,000 bucks a share, it's a little higher than that, of course. But basically, if it was around number 2,000, you might have to buy a 2,100 call, 100 points out of the money. Now we'll be able to buy, with the stock trading closer to the low 100s, say the 110 area, we'll be able to buy something in the money, controlling the stock and reducing the time dollars that you have at risk. I'm going to go deeper into this, but let's just walk you through main benefits of what I want you to take home from my quick 45 minutes with you today. First of all, if you don't know what FANG stocks are, we'll walk you through why they're so powerful as leading forces in innovation and why you want to be able to take advantage of that innovation up and down. I've been telling people really for decades why you should be able to trade puts and calls, but heading into this year, I said we were cautious about the outlook for this year. And frankly, we're still cautious until we get into the fall, until we get into ahead of the midterm elections. You know, you need to be able to be positioned to trade the downside, not just the upside. That's what this strategy allows you to do, is trade both directions. And it's allowed us to be able to beat the market this year despite the market decline. So bottom line is that, look, we want to use weekly options on these. These are options that expire every Friday. But like right now, here we are on a Thursday, I would not be trading tomorrow's options that are about to expire tomorrow. I would be trading next Friday's weekly options, the fourth Friday of the month, of what they call the week 4 options. So whether you trade Google and the other FANG names, you're going to be able to learn how to do this. Now, the other thing is that I want to give you an insight into my number one favorite indicator that helps you to find a trending stock on any time frame. So I'm talking about moves that I expect to happen over 2 to 3 trading days here today. But the bottom line is that you can apply what you learn here across positions that you might hold for days, weeks, months, or years. Just change your time frame in what you're looking at on the chart. And then we're going to set up a very special stock split package for you to take advantage of even more bonus savings in celebration of the Google split, because I want you to get involved and start taking advantage of these FANG names. They're so powerful. So what are the FANG names? Facebook has renamed themselves. You know, as we know, Facebook was the F in FANG. Now they've renamed themselves as Meta Platforms and changed their symbol to META. So does it become MANG? I don't think so. We're not going to mangle that one. We're going to focus on the original FANG acronym, which was Facebook, Amazon, Netflix, and Google. Google's even renamed its parent company to Alphabet. Go figure why they're into renaming themselves. But we still Google something when we search for it. We don't alphabet it, right? So the idea is that, okay, FANG, that's your original 4 FANG stocks. We've always said all along that the 5th one that should always be included in there is Apple, AAPL. And so you see sometimes FANG written with 2 A's in the middle. But the point is that just focusing on these 5 stocks and the options on these 5 stocks gives us a way to really focus on technology leaders. You say, well, Amazon's a retail stock. Well, they do, of course, the web is the way that they drive about 1/3 of all e-commerce transactions, is what Amazon dominates, right? You know that Netflix, it's had a tough last year, but bottom line is that they've been a leader for the last couple decades in streaming content, binge-worthy content. We know about Google and searching, and the focus of searching. Facebook with 2 billion users are already looking into the metaverse as to how they can attack another universe of opportunities. And of course, Apple, we've got a more powerful technology in our pockets with cell phones than we ever had just a few decades ago with mainframe computers. So the bottom line is that this is innovation leadership here. You want to be able to trade them, but the reality is they will go up and down to help drive the markets, and you need to be able to trade both the up and the downside. So we're going to talk about a downside opportunity first that we cashed in on. This is what was called buying a put option. If you're new to options, if you buy a put, that means you've got a right to sell the stock at a fixed price. That right to sell gets more valuable as the stock drops. So that's why if you're betting on stock dropping, if you buy a put and the stock drops a lot, you can make a lot of money really fast in put options. There's always risk you could lose what you put into it. That's why we've got to have strict risk management about how we're going to get out of trades that aren't working too. So we're going to talk about that too. So in this example, we recommended to our FANG Options Trader subscribers that they buy into this Google 2180 strike put We paid for one contract, we paid 9.20. But since one contract controls 100 shares of stock, you have to multiply that 920 times 100 shares to get $920 invested to control 100 shares of stock. That sounds like a lot of money to a lot of people, but the reality is, think about it. If you had 100 shares of stock at 21.80, that'd be $218,000 worth of stock that you're controlling for less than $1,000. That's more than 200 to 1 leverage. So you say, okay, look, when the stock drops the next day, we were able to cash out. Our $920 became $1,840, and we made $920 in profit before commissions. And of course, commissions now are minimal compared to what they used to be. When I got started trading in 1990, 32 years ago, I remember having to pay ticket charges of between $30 and $50, even if I was trading one contract. Now with just one contract, you would pay $1 or less per contract without any ticket charge. So even round trip, if you're paying $1 a piece, that'd be $2 off of your 920. You'd be left with $918. You're keeping the vast majority of what you make, and so commissions is less and less of a factor. We know that past performance doesn't guarantee future results, but we do know that, look, if we're telling our subscribers, look, say you put up $2, but no more than $1,000 into each trade, you can participate in each trade we recommend, because we're not going to recommend something for more than $10 or $1,000 for one contract. Now, of course, a picture's worth 1,000 words. So let's start to get into the charts and show you how I found that trade, show you the exact setup. And we're going to walk you through my number one favorite indicator on here, which is this green line here. The way that I use it, it's called the ADX. Wells Wilder developed it. It's the average directional movement indicator, ADX. And ADX, you can see here that when we're getting into this trade over here, we're actually recommending to bet on the downside with the down arrow, when the stock in this example was trading just under 2,500 bucks. Say, whoa, you had to buy out over 300 points below the market. That's a way out of the money put. It's because there was an earnings report that was coming up about a week later that was priced into those, and we weren't worried about that because we knew we'd be out before the earnings report. We're not into the strategy to take earnings gap risk. We're trying to cash it in before the earnings hit, or once the earnings are reported, then come in and trade it after that, and take more of the gap risk off of the table, out of the equation. So in this case, like I said, we paid 920 bucks to control the stock at 2,500 bucks. Of course, 100 shares there would cost you $250,000, 250,000 bucks if you were going to just trade the stock on 100 shares. No thanks. Let's control $250,000 of stock for $920. And you see the stock drops the next day. And look, it didn't have to go down to 2180 or below. It dropped down here around 2440. So the stocks dropped 60 points, or about 2.5%, and that led, in this case, to a 100% profit that next morning. Okay, so from April 21st to the morning of April 22nd, literally, you can see these are 30-minute candles, by the way, 30-minute candle chart on Google, GOOGL. This is on TradeStation, but you don't have to have any one platform to take advantage of this. You just need to know that when we call out a real-time email alert to get in or out, and then we'll also send out text alerts to your smartphone when you become a subscriber. And I've got this great starting package to allow you to lock this in at incredible value. So hang with me for a bit. Bottom line is that we take the bird in the hand. We take the double whenever we get it. If it happens the next bar or two, in this case, it took a whopping 4 bars later. That'd be 2 hours later in trading time. And of course, it was the next trading morning. So it's not a day trade. We're usually in these trades for 2 to no more than 3 days. We can be in and out the same day if we get our targets that quickly, or if we hit our stop that quickly. But in this case, you say, hey, you got out too early. It went on down even further. But you see, if you're waiting for the ADX, which our entry signal here says ADX crosses up above this declining directional movement in blue, which is in this case the positive directional movement, which means how many new highs you're getting when you look back on the recent new highs in this chart. Not many, right? You can see the red new lows line, which is the negative directional movement, says how many new lows you're getting. Plenty, right? You know what that's called. That's a downtrend. Now, by the way, you see I'm not calling the exact top or bottom of this market, of this play in Google. I'm trying to catch what I call the sweet spot, which is usually about the middle third of the trend here. So if I block that out here, that's the middle third. That's what I call the sweet spot, okay? So I'll call it SS for sweet spot. But basically the sweet spot here is to say, look, that is the easy part of the trend, the middle of the move. If you try to call tops and bottoms at the turning points, if you can do that well, you probably need to go work for a hedge fund or something, because the bottom line is that that's something that's really hard to do. The hedge funds try to do it. A lot of them go belly up. Some of them do really well, but the bottom line is that that's the minority. The majority of our trades are best in the middle of that move. So the sweet spot is the easier part of the move. That's also why I use ADX coming off a relatively low level. What does ADX mean? Average directional movement. It means when you're seeing more new lows and no new highs, that's a downtrend, right? You can see that on the chart already forming. It's no big surprise. We even use a trend filter up here in black to say we've got to be below that trend filter to take a bear trade. We've got to be above it to take a bullish call trade. So that also adds to our confidence that we're not just catching a little fake out on the intraday short-term charts here, okay? We're catching that sweet spot move in progress. We get that double, we take the bird in the hand. And when you're out of the position here, you see if you were riding and hoping that it's going to keep going the next morning and instead gets this big hard flip back up, you give up a big chunk of your profits that you just made the day before when you wait too long. I'd rather be out early. It's kind of like if you're in the crowded theater, somebody yells that dreaded word and everybody rushes out, and you say, look, you're left behind, you're going to get trampled. You're going to get, or worse yet, you're going to get fried by basically being too late. You've got to say, let's be out a little bit early before the rest of the crowd, and it's a lot smoother and lower risk type of a ride. Google, of course, is priced a lot higher in that example, but now what's going to happen is when Google goes ahead and splits after tomorrow's close, you're going to see incredible tradability here in Google. You're going to see a situation in which Google essentially is going to be trading now from the 2000s, low 2000s, and it's going to be trading now into the low 100s. So like Google, as I started here, was like $2,200 a share, give or take. So you take a factor of 20 down from that, right? And you're at $110 a share. So if we're now bearish on Google, instead of having to buy way out of the money and still pay $1,000 or less per contract, we'll be able to trade something like a 115 strike put when the stock's at 110. That'd be 5 points in the money, and maybe we pay $600 or $700 a contract for it. So that totally changes your risk reward dynamics to where if nothing happens in Google and you buy a well enough in the money option, you dramatically lower your time risk on the trade even, and it gives you a lot more staying power as well to ride these trend moves that I'm showing you. So really exciting. Amazon's also just gone through a 20-for-1 stock split a little over a month ago, so it's also a lot more tradable than it used to be. So all of our FANG names are really in a sweet spot now in the $100 to $200 a share range, where they're very tradable and very easy to leverage. Of course, you know, Apple, biggest US-based stock out there, one of the biggest stocks in the world, of course, behind Saudi Aramco, the energy stock. Bottom line is that, look, Apple's another one we cashed in on a put trade on not too long ago. And this was an interesting one to me because when we got our signal on Apple here, you can see we're getting in here when this stock's trading about 169.5, and we bought a 177.5 put. That was 8 points in the money. Actually, it bounced a little bit by the time we got filled. We got filled $7.30, $730. It was about 7 points in the money when we bought it. So of that $730 we paid to control Apple on the downside, we actually only had about $30 of time risk, or less than 5% of our total option premium was time risk. That was important because you can see that initially what happens, it ran back up and it tested up towards about the 171.5 level. We were wrong by about 2 points on Apple, and we still didn't get stopped out. Usually we're going to start with about a 50% loss, but we're going to tighten the stop steadily to where we'll move it up pretty quickly to a 30% loss. And then when we're making money on the trade, we'll move it up to a break even as our trailing stop loss. And eventually, of course, we start protecting our profits more and more as we get bigger and bigger profits. If we haven't gotten to the double, you can see in this case, when it was against us, our rule said actually we should take that 55% gain when it popped down there 2 mornings later. You can see in actually one official trading day later, it went from a Friday to a Monday exit here, and we're cashing it out in the neighborhood of about 167. Think about it. At 167, if we have a 177.5 put, That's worth 10.5 bucks intrinsically. You see we sold it at $11.36. So it still had some decent time premium in that position. You can see it edged down a little more. But again, if you're passive, if you wait, one of the big lessons here is don't be passive in trading, okay? Be proactive. If you wait for this close of this bar here, you see where it closed? It closed about 169 and a quarter. We're out at 167 on that first pullback, the start of that week on the 11th of April. So the point is, don't be passive, be proactive. We make 55% instead of giving up most of our profits when it pops up a couple more points the next morning and would be against you. So the point is, okay, proactive, following a plan based on a trading system will give you a tremendous edge and not getting subjective. And what a lot of traders I see do is they start off as short-term traders and then they become long-term investors. They say, well, Apple's a good company. It's against me right now, but I'll hold on and eventually it'll work out. You don't have that kind of time to wait, folks. You need to make sure that you are really saying, look, this is the sweet spot. If it's going to work, it's going to work in this short window of time. If it doesn't work, we have a plan to get out. Here's another one now, talking about a bullish call option purchase on Google on the upside. So again, you see this happening a lot of the times right off the open. This is starting to turn up here. Now look how our positive directional movement is moving up, our negative directional movement is moving down. What does that mean? Again, it means you're getting higher highs, higher lows. You know what that's called? That's called an uptrend. Okay, we want to catch the trend phase. We don't want to trade the chop. There was a lot of chop back here where not much is happening, and we put a big X through that and say, don't try to trade every bar, every price movement on the chart. You're making a huge mistake if you trade every squiggle, because what will happen is that then it'll get you focused on how to trade a range-bound market versus a trending market, and then you'll be thinking you're in a range-bound market. You'll be selling high, and it'll go way higher, and you'll be on the wrong side. You'll not be ready for the big trend move when it develops. So this trend move develops here, and we're getting our signal to get into Google calls. This one did not have an earnings report, so you'll get a better feel for what we had to do previously here. We're about 2770, 2770. We bought 2860 strike calls, about 90 points out of the money. Now, that sounds like a lot, but in percentage terms, that's barely a little over 3% out of the money. And you say, okay, that's really not that far out of the money. Actually, you notice that by the time it runs up here at about 2810, it's made about a 50-point move, not even quite a 2% move in the stock. And we're getting 100% move, 50-to-1 leverage in the option in 2 hours. So like I said, if we get that move the same day, sure, we'll take the double in 2 hours. Who wouldn't? But the idea is that we don't want to be one of the big things I'd want you to key on is you don't want to be too quick, too hair trigger to take your profit and say, ooh, Google's up 30% in an hour. I think I better take it. In 2 hours, we're up 100%. The idea is that, look, if we can get some of the risk when it's not working, lose 20, 30, maybe even 40%, worst case 50, you need to have doubles that can help offset that. You know, and if you're taking, say, an average of a 25% loss, then when you get a double, you could take 4 of those losses, have one double, and still be even, right? So the beauty of this is that that's what we call the asymmetric leverage of options. That's a technical term that just means you can make a lot more money than you can lose. If you can keep your risk limited, and then you can see your profits really start to multiply on themselves. That's what the whole reason I got into options more than 3 decades ago was, because I knew I could make multiples of what I could lose. Doesn't mean you have to risk 100% and try to make 200 or 300%. It's more meaning control your risk in the 25, 30, 40, no more than 50% area, and then doubles can really easily offset multiple losses. So the beauty of this is that you see it just grinds up. You see after we get out, it goes flat into the next day, bounces a little bit more. I don't care what happens later after that. I care more about making sure that we take advantage of the double, the bird in the hand, in just that very sweet spot window. See what I'm talking about the middle third of that move? That's the best part of that move, the fastest movement, also the most consistent movement without any drawdown in that particular example. We're going to get drawdowns from time to time, but the point is that if you've got this stability, especially now with the stock split coming up tomorrow for Google, to say now I can buy more in the money options and dramatically reduce my risk. Let's look at another in the money example here, because you're not going to always get doubles. Let's look at some other potential outcomes. This is a great example with Apple. And Apple, you know, has been priced in that sweet spot area for quite a while. This was back when it was trading in the neighborhood of about 131. We bought a 123 strike call. That means you got a right to buy this stock for 123 a share. It's already at 131, $8 in the money. We paid 9.18. So out of the $918 we'd pay to buy one contract controlling 100 shares, 800 of that 918 is already intrinsic value, meaning that we're only paying 118 bucks of that 918, or put it in percentage terms, about maybe 13% of the option is time risk. That means if nothing happens and Apple stays dead flat at 131 at the next Friday's expiration, then we would have to say, okay, we've lost that 13% on that trade. Obviously, you have price risk too, so you could lose more than 13%. But when you can limit your time risk to just 13%, it gives you a tremendous stock substitute. Why would I ever buy a stock again if I know I'm going to hold it 2 or 3 days, 3 days maximum actually in this system? Then, okay, look, we know we can basically get tremendous leverage against a relatively small percentage move in the stock. In this example, it barely cleared at the signal point, which is this yellow second 30-minute bar in here, barely cleared at the close of that bar, that longer term trend filter. So it just went positive at the close of that bar. If it had been underneath there when we got our signal, we would not have taken the trade. You can also see after that quick burst in Apple over that first hour of that trading day that it had a very slow, meandering kind of a grind higher, but not by much. We're not making much money on day one on that trade, but we're not losing much. And because we have the in the money option, we've got a lot of comfort that we're not going to get whipsawed out of this trade. If you buy out of the money options, especially with weekly options that might have a week or less to go till expiration. This one had about a week and a half till expiration, but still, you buy an out of the money option, it flattens out on you or even has a little retrace against you, you're going to get whipsawed out of otherwise good trades. You can see day two, we're making really good money as it gaps up and then keeps going. And then it actually pulled back a little bit the morning of the second full day in the trade. You can see that we're in this trade about 48 hours. And you say, okay, that's essentially our 60% gainer that next morning. Turns out it would have gone to 100%. I don't care. Woulda, coulda, should. I'll take the 60% gain, bird in the hand, if it hits my trailing stop. And we call this a profit protection rule. Say, look, if you're up healthily, you're foolish if you don't have a plan to control and keep most of those profits. If you look at your trading wins and losses and your winners and losers in the trading game, you read the stats that most people don't win in trading, and it's because they let their profits slip away too much and let profits turn into losses, or they ride their losers too long and let small losses turn into big losses. These are the kind of mistakes we'll guide you through with our trade alerts. You're never left hanging with big trends alerts. We always call out not just every entry, but always every exit. Even if it's a loser, we want you to know where it stands and how you get out of that and move on to the next trade, win, lose, or draw. Okay, so here's another example with Facebook, now Meta. At the close of these bars is where we're getting our signal. These are 30-minute closes here. So stock's about 257.5. We buy 252.5, about 5 points in the money. We paid 910 bucks, or about $4 time value. These days, that would be too much time risk for us. When we can get time value closer to 20% or less, maybe 25% max, why take more time risk than we need? So, but you see, we paid 910 bucks for that, and you can see it worked out. Less than 24 hours later, we got a doubler the next trading morning. So again, that's not a day trade. We're sensitive to the fact that if you're a smaller trading account, you do too many day trades, you get yourself locked up. So we definitely will monitor this and not give you too many day trades ever with this strategy. It's going to be focused on, okay, if we've had no more than 3 day trades in a 1 week span, then we would basically wait for any new trades until we're past that week. But the point is that we want to average typically about 1 to 2 trades a week over the course of a month, about 6 to 8 trades a month. So we're not going to be hyperactive. We're going to be focusing you on the best of the best opportunities out there in the market today and the FANG names. So let's look over here at our next one here and show you, here's another Apple example. The reason I love this example is because look, here's our crossover point on ADX moving above that declining negative directional movement, says we're starting to move into an uptrend here. But you look back on the charts and you go, hold on, this stock is not broken out price. What are you talking about? Upside breakout. This looks like it's right into resistance. But what the ADX shows you is it shows you that the trend structure has now said we've gone from trading range to a more clear uptrending environment ahead. It's looking not just backwards, it's helping you look forwards at what is the structure of the market. The structure has changed from trading range into trending. Now it's time to be buying calls, betting on higher highs and more gains to come. And so that's why I said, look at the first third of that move. It's slowly grinding up, right? What's happening in the first third of the move? Nothing clear yet. It's starting to make some progress, but it's slow. But as the clarity develops, and you see what happens the next morning, we gap up and then everybody pours on the gas, right? So the gap up, everybody's like just waiting for the price breakout. It's like, yeah, price breakout. And then it trends up the rest of that day pretty much, and we get out near the end of that second day in the trade. So here's my point on the trade the structure, not just the price of the stock itself. The structure of the chart got us in at 116. If you wait for the official price breakout, you get in 4 points higher at 120. We're out of the trade closer to 124. So think about it. We made 8 points on that stock, and that was our 75% gain in the option. If you bought it halfway through that move, we're in at 116. You buy it at 120 and go from 120 to 124. Great, you made 4 points, but you left half of your profits essentially on the table. You were late, and therefore you only got 50% of the total profit move that we got. So maybe you made in the mid 30s instead of the mid 70s. So the point of this is that, look, you don't want to be late. You want to be able to follow the structure. We would call it out to you. You see, this was signaling around 1 p.m. on that day. We call it out with a real-time email and text alert to your smartphone as a subscriber. And by the way, when you become a subscriber, you get all my settings for ADX, the DMI lines, the trend filters, etc. So you get all that sent to you as well, so you can plug it in on your end and watch on whatever platform you want to watch on. But the big thing is that when we call it a trade, we want you in here on the star, not the next day on the X, okay? We don't want you late. We want you in at the right time when it's just signaling, not later when the move's already developing and you've left money on the table if you wait that long. So we don't want you to be late. So when you add up all these wins and losses together in the FANG options trader recommendations that we call out, the beauty is it's just 5 stocks to follow for us. We can easily do this and then call them out. And you look back over the last 4 months worth of trades, you can see just going back here into March, and we just updated this as of Monday. So you can see here that looking back over these last 4 months of closed out trades, including not just winning trades, but all trades, win, lose, or draw, and putting in this example, 10 contracts to trade. So now you'd be potentially putting in up to $10,000 a trade. You can see that now you're looking at $9,670 of total profit, adding up all winners and losers before commissions over the last 4 months. That's only a third of the year, right? And that's in a year that people have been like not too happy about their other investments in their broader portfolios, right? Most people are down this year. Just tracking what we've had a 20+% drop in the S&P this year, a bigger drop in the NASDAQ. And so the point is that, look, when the market's down, this becomes a great way for you to hedge and add in downside opportunities where maybe you're used to just having a pretty predominantly bullish, better go up kind of bias. We say, look, you've got to have the flexibility to trade both directions. That will help you to hedge your other investments. It'll also help you to start profiting from downside bear markets. And they don't have to last that long. The beauty of it is we know we'll be in these trades no more than 3 trading days. So you're not hanging around hoping for something to develop too long. If it doesn't develop, we get out, we move on to the next trade. So the beauty of this is that, okay, look, this is using a $50,000 model portfolio. If you're using a $10,000 model portfolio, okay, break it down to it'd be just under a couple grand, something closer to about $1,900 of profit on a $10,000 portfolio over the last 4 months. That's still tremendous, and adding up to healthy gains on a month-by-month basis. We can't guarantee what the future is going to hold, but the point is that we're following a systematic approach where we can guide you through up or down markets with this DMI ADX combo. My favorite trading indicator for these options on the FANG name. So let's go a little deeper into what these indicators are. What is directional movement and the DMI directional movement index? What we're looking at here is this is the same guy, Wells Wilder, who invented RSI. Many of you know that, the Relative Strength Index. It's probably the most popular overbought, oversold oscillator in the trading world today. On this particular indicator, Wilder said his contribution was many, but in this indicator, he said, look, when you talk about the high-low range for a stock, most people say that's the range of the day, right? And say you look at day 2 here and it opens and closes at the same level. Most people would say, well, that second day's range on this chart here, we'll call it little r. Okay, it's the high-low range, right? And Wilder say, wait, not so fast. You better use the prior day's close, and on an up gap, say, look, if you take from the prior day's close, the true range, including the gap, is a lot bigger, right? Because it gapped up. The true range factors in and includes the amount of any gap. As you know, gaps are tremendously important, and you want to be on the right side of gaps a lot more if you can. And so what Wilder says, okay, average out all those true ranges looking back over whatever time frame you want to look back on, and you'll get the total movement you're getting in the trend on a typical average true range divided out over a number of days or bars or candles, however you like to look at the markets. The DMI shows you the net new movement you get. When we said net new highs, that's a positive DMI. Net new lows, that's the negative DMI. So of course, if you're getting more new highs and no new lows, that's your uptrend, right? You're going on up. So the beauty of this is you say, okay, look, if we get the uptrend happening here, that's going to be set up for ADX can be trending in a positive way with the DMI lines overlaid. ADX can also go up on a downtrending market, and then as I showed you before, the DMI lines just flip. The negative will be above the positive. That's why I always include the DMI lines on my ADX panel so you can see that really clearly who's winning the war, the bulls or the bears. The positive above the negative, that's a bullish trend. Negative above positive, a bearish trend. So ADX shows us when those lines are diverging from each other, DMI plus and minus, and that's what's going to pick up that there's a widening gap between the directional movement to say that there is indeed a trend forming. Here's a prior Amazon example on the downside. Our longer term trend filter is negative. ADX is crossing up, and the negative directional movement was above the positive. So the bears were in control here on the gap down here, right? So we got a bear signal off of that first spot there, just under $1,800. We bought a 1,745 strike put. These days we would have had to go out further because we'd keep it under $1,000 a contract. Back then we were willing to go up to $1,500. Now we said, look, we've gotten what we think is better over time, where we can actually keep it under $1,000 a contract. And you can see that was on the first trading day. It was edging a little bit in our favor, but not much is happening. We're not making much money on our first trading day. But it was the next day. It was actually on Monday morning, that next trading day, where the stock got pummeled down soon after the open, and we made certainly an atypical outlier, 243% by the time we got filled. As we call it, these trades, send them out through real-time email to exit and text alert to exit. Basically, by the time it got out there, the stock had plunged even more. We made more than our double. Way more, but you shouldn't expect that. You should say, look, double works just fine when you get your profit targets. If it happens to gap and you get more than that, then that's a happy outlying event. But you see, this is another example where it edged a little bit lower, and then by the time ADX really reverses, it's flipping back up where you haven't really made any more money versus where we got out, and you've also lost another day of time and another day of gap risk. So we take that off the table. Now, if you don't know what weekly options are, this is a tremendous tool. If you know you're only going to be in a trade for a few days at max, every Friday is an expiration on the weekly options. And it used to be that only the third Friday of the month, the monthly options would be the only week I could trade the strategy. But when weeklies were added, we've been thrilled that it gives us so many more alternatives of how we can trade to take advantage well in front of events like earnings, or even after events like earnings, where we find these runs and up or down on the trend ADX indicator, and we can trade them on mainly individual stocks is how we like to do it, but you can use indexes and ETFs with weeklies as well. So how about another example with Netflix on a quick weekly options winner there. Now, when you look at this, this is a great example because when we got our signal on Netflix, it's at the close of this huge first 30-minute candle. Stock's about 355. We're buying the at the money 355 call at the time. Now, of course, Netflix is under 200 bucks a share. But the point is that we're paying 905 bucks. And a lot of people would say, hold on, you've missed the move. It's moved too fast. Do you ever fear that you're missing a move, that you're in too late when it makes that big of a breakout? I think we've all had that fear or concern at times. What ADX just starting to rise off of a low level tells me is there's more meat on the bone. Sure, it went through a little bit of a flag pattern here. You can see this flag forming here. It's just kind of filling back and forth. And you say, well, aren't you going to get stopped out of that because it's not trending really? It's just going sideways. Look at what the ADX is doing here, folks. ADX is rising through that whole flag period. How is that possible? Because you're losing older data back here and you're picking up higher data that says we're still trending at new higher highs than what the old data that we lose is. So ADX is much more stable than actual price action. That stability is very important to your ability to stay with the trend. You've heard the old phrase, right? You let winners run, you cut losers quickly. Most people do the exact opposite. They take their winners too fast, they hold on to their losers too long. ADX gives you the ability to stay with the trend longer, stay with the move, and be around for the second day, in this case, where it almost gets to its double, didn't quite get there, and our trailing profit protection kicked in, and we only made 85% the next trading day. So the beauty of this is that stability of ADX is your guide. By the time, in this case, the ADX rolls over and our profit protection kicked in, we're done with the trade. Whatever happens from there, you definitely say, okay, that's fine. Move on to the next opportunity. And here's a warning for you. When ADX rolls over, does not mean you should trade the other direction. The positive directional movement is blue, so way above the negative directional movement. It looks like this one's continuing to move on up a little bit afterwards. You don't want to try to bet that an ADX rollover means the trend must go the other way. That's not the case necessarily. So it's all about finding this pattern and just trading when that pattern, that window is open. When the window closes, we're done. We go back to the sidelines on that stock and we wait till the next ADX setup. So the beauty of this is that you're focusing on higher momentum FANG names here. You're not worrying about things that are moving slow. As I mentioned to you at the beginning, Google, a great example of a recent put winner where we were well out of the money. It did not need to go down to the strike price. It only needed to move about 2.5% for us to make 920 bucks or 100% target profit gained in just about 24 hours, from one day to the next. So the beautiful thing, it's truly revolutionized the way that a lot of traders think about catching a quick move, not having to be a day trader to do it, but knowing that you don't also have to screen watch all day. You just get real-time trade alerts through both email and the beauty of that text popping up on your smartphone. Just boom, makes it right aware to you. We've got a new signal. These signals will come at the end of any half-hour bar, so it won't come during the half hour, but it'll come like if it's at 1:30, we get a signal. You'll usually see it hitting in the next couple of minutes on your email and your smartphone that it's time to buy this call or this put on this stock. So really clear cut, really simple. And we're not doing spread trades here, folks. We're not doing multi-legged transactions. We're just buying a call or buying a put. When it's time to get out, we're selling that same option that we bought to close. We're closing it out. So there's no adjustments, no rolling, no confusion about what you need to do. I've found the KISS principle, keeping it simple, is my most effective strategy to get the most money out of a trend trade move. So it really works nicely. As I mentioned, when you take a $50,000 model portfolio, and you say, okay, in this example, we're saying if you're just trading 10 contracts a trade, that you could have made 9,670 bucks off of a $50,000 model portfolio in just 4 months. The last 4 months look back. We know that past performance doesn't guarantee future results. Future results will vary. They could be less, they could be more than this over the next 4 months. But the reality is it will vary and you should plan accordingly. One of the big things I ask new subscribers coming in to do is start small and be consistent and start to gain confidence in the method over a reasonable sample of trades. So the beauty of this is that I want to give you enough time to take advantage of being around for months and hopefully ultimately years, but I want you to take advantage of a great special that I've set up for you. I call it my stock split trading special package. That with this stock split special, say that 5 times real fast, stock split special, you're going to take advantage of the fact that we're celebrating that Google coming down by a factor of 20 from 2,000 plus bucks a share down to about 110 bucks a share makes for a lot more trading opportunities. We'll be able to trade on Google. Amazon's recently done the same thing. So now you can really trade those actively and within the money options where you get a true stock substitute and you dramatically reduce your dollars at risk and your time dollars at risk. So what I'm going to offer you, we're going to talk about how you can lock in not a month or a quarter, but actually 12 months of trade alerts from our FANG Options Trader Service. As I said, we're trying to do in the neighborhood of about 6 to 8 trades a month. So over the course of the year, 75 to 100 trades in a year. That, if you bought it month to month, would be more than a $2,300 value if you paid our usual 197 bucks a month list price for 12 months. But I'm also going to throw in some extra bonuses, and we're going to dramatically reduce that price. So stay with me. X out the 2,300 and say, guess what? I'm going to take it down to here. Well, you think about how much you can make off of. You remember I showed you one trade in Google could have made you 920 bucks. The Apple trade that could have made you over 500 bucks. Another Google trade that made you 800 plus bucks. We're going to get into that, but I'm going to give you unlimited email access. You can, if you've got questions, you can email me and my research team of analysts, and we'll get you prompt feedback so you know exactly. There's no confusion. You're taking advantage of each opportunity as we call it out in real time. I give you my settings and rule sheets so you can plug it in and follow this. I give you weekly video training where I teach you what I'm seeing on all 5 of the FANG names each and every week. That's just up every Monday at 6 p.m. My best pricing is typically $497, and we've had a lot of people that have locked in that kind of value for a year, just 497 bucks. I know a lot of other services that are charging thousands for this, and our service gives better performance for a lot more bang for your buck. But you know what? In celebration of the 20-for-1 stock split on Google, I'm going to take that 497 down even more, and I'm going to take it down to just 397 if you act quickly today. Stock split special that gets you 12 months access. As I said, at 197 bucks a month, in 2 months you basically now can, and in 2 months investment on our usual monthly purchase, you now basically turn 2 months into 12 months with this one-time investment to lock it in for the next year for just 397 bucks. The first 20 buyers today also get an extra bonus from me. I'm going to throw in my weekly options boot camp. This is multiple hours of training on what to look for with ADX, with weekly options, how to trade the quick trends on the FANG stocks, and how you could do it even in other sectors and other stocks like Microsoft and more, AMD and a whole bunch of other stocks you could trade with this. You can see that adds up an hour 24, an hour 13, and an hour and 4 minutes on each of those 3 sessions. 3.5 hours of training, a bonus $297 value. I'm throwing it in for free when you lock in this $397 offer. I only have a couple more minutes, so let me show you when you go to this page here, and hopefully Anna can help paste this in for you. members.bigtrends.com/split. Okay, go to members.bigtrends.com. I'm going to do it right now, /split, and I'll show you what it looks like when you pop up that page here real quick. Okay, it's popping it up right now. Boom, there it is. It's not going to be up there that long, but $397, when you lock it in today, you're saving, like I said, literally almost a couple $1,000 you're saving off our usual $2,300 plus price point that if you paid month to month for the service. So you're saving over 80% when you lock it in at members.bigtrends.com/split. We take not just the major credit cards, but you can click the PayPal link there. You do agree to the terms and conditions when you get signed up. You have to check that box, and it's linked there below. It's also linked there on the checkbox. So check out the terms and conditions. We've been in business 23 years and going strong, and looking forward to serving you over the next year with great FANG options trader trades and a learn while you earn mentality to help educate you along the way. I'm out of time, but I want to make sure you get that link, members.bigtrends.com/split. Make a note of it. Go to it after our next presenter. You want to soak that in too, but I know it's going to be great value and great training for you how to leverage the FANG stocks. Thank you, Anna, so much for having me. Always a pleasure.
Today, I'm going to talk about trading futures. A lot of people think that futures trading is risky, and I'm going to dispel you of that notion. This is also known as futures trading for the uninitiated. My passion is in helping beginners and intermediate traders. This talk is for those who have not tried futures or who have not traded much and want to learn, or those who think futures are risky and who want to improve their own trading results. So it's for beginners and intermediates. Obviously, if you've been trading futures all along, it's going to be a little elementary for you. You need to know, of course, that there is risk of loss in trading anything, including futures, and that you can lose all with futures, not only all that you have traded, but you can have a margin call and lose even more than that. So we're going to talk about that too. A lot of people start by choosing stocks, to buy and sell stocks, swing trading kinds of things, but fewer have traded futures because the word on the street is that they're too risky. So I'm going to teach you how I trade futures from my own account. I've been trading for 41 years. I trade both futures and stocks and crypto. I'm not like Price, though. I don't know how to trade options. The only thing I found out how to do is how to lose money with options. So Price, if you're still there, one of these days you need to teach me. I'm going to tell you a little bit about myself, but first I'm going to show you how I trade. I trade the S&P futures contract, S&P 500, on 1 minute and 5 minute charts. I have long-term stock holdings, which long-term to me, when I'm used to 5 minute charts, means a week or more, sometimes a month or more. And I trade a little bit of cryptocurrencies. And this is the chart that I use for all my trading. The bands that you see around price are my sunny bands, and the histogram on the bottom, which is purple, green, gold, and red, is my dynamic moving average histogram. And let me go back to that just a second. You can see on this chart that when it turns red, right here is the time to go short, and when it turns green on the bottom, it's possible to take a long trade. But I only take a trade that's signal when price confirms it. Price trumps everything. And this is the kind of insights you can get for free by signing up for my Sunny Side of the Street free Sunday night newsletter. Email me or call me if you can't find it for any reason. But if you go to moneymentor.com, you can pull down under articles to Sunny Side of the Street. Or you can email me at sunny@moneymentor.com. And I put my cell phone number out there for everyone. If you want to call and just chat about what you're trading, find out more about Sunny Bands, feel free to give me a call. So just quickly, I was rated #1 trader twice by Stark Research, and I was using my Sunny Bands and my dynamic moving average to do that. Back then, I was trading on 15-minute charts. I don't engage in contests, though. This is real money. I was a commodity trading advisor, and you can see right at the top, there's my trading firm. I have 3 degrees in mathematics, and then after I retired, I got a AA in photography and film. I've been to Stanford, UCLA, and the Wharton School of Business. I've been programming for 52 years and trading for 41. I was a systems programmer for Lockheed, and I founded a little company. There were 3 of us, and we were the world's leader in computer graphics software. And by the time I retired from them at 30 years old, we had 105 employees working under me. So I did what I thought was the smart thing. I gave my millions to money managers. Turns out that's a very bad idea. It took them 3 weeks to lose 75 grand. So I took the money back and taught myself to trade. Before I began trading, I spent the first year reading, and I read 117 books on trading, investments, options, economics, all kinds of things. And now I've read 744. I have an extensive library. And I didn't enter a single trade the first year of watching the market. I wanted to learn the rhythm and learn what I thought worked before I did any of that. I published a monthly magazine for 8 years called Trader's Catalog and Resource Guide. And I've written 5 best-selling books. so far, and I'm now, oh, and I wrote another one called Going Vegan with my friend Linda Blair, the actress. And now I'm working on Easy Language, OOEL, Object-Oriented Easy Language, with Sam Tennis. And I've written articles for all the major magazines. And I still continue to write. And here are the covers of the books, so you can see the books real quickly. And I wrote Using Easy Language 9.x with Murray Ruggiero. And there's the one I'm currently working on. I've been rated in the top 10 consultants and top 10 courses and seminars by Technical Analysis of Stocks and Commodities magazine. And I belong to all of the prominent societies. And oh, and yeah, Market Analyst of Southern California is in there. Okay. I am a consultant and a mentor. I love to help people learn to trade. I post free my look at the market on Facebook. And if you want to opt in for free for the sunny side of the street, I'd love to send it to you. I've got on my, oh, and I do a free live trading room every Tuesday morning at 7 a.m. California time. So if you want to go to moneymentor.com, you can register for the free trading room. And there's all kinds of white papers and articles and slides of presentations there if you just join up as a free member. So let's get to it. What are futures? Well, they're also known as derivatives because the future value is derived from the underlying instrument. So the S&P 500 is a basket of 500 stocks, and then they derive a futures contract from that cash value. In many ways, they're not like stocks. In others, they are like stocks. If you own a stock, you own a small piece of a real company, and you can hold it forever. Stocks don't usually drop to zero, although some do. They don't usually. If you trade futures, though, you're buying a contract to take delivery of a commodity at a later date. And of course, you could lose more than your initial investment if you don't manage your money. You've got to manage every trade you get in. You can buy stocks, and if you want to set up a margin account and the stock is, quote, borrowable, then you can short it. I don't short stocks. I just buy and get out and then buy again and get out again. But you will have a margin account if you trade futures because you're borrowing money from the exchange. Let's talk about what is shorting. I mentioned that word short. Shorting, well, let's say long is buying in hopes that the commodity or stock will go up and then you can make a profit. But short means you're selling something you don't own on the promise that you'll buy it back later, and you're hoping that it will go down. So here's what a long trade looks like. We get in there and we write it to the top. A chart, here are two short trades shown on this chart. And you can see that every one of those trades is signaled by the sunny bands. The gold and purple lines on the middle are called my dynamic moving average. I invented this because years and years ago, I found out that moving averages whipsaw and you lose all your money because the market trends only 30% of the time, and it's chopping for 70% of the time. So chances are you're going to get caught in whipsaw. And I, with my degrees in mathematics and my master's thesis in hand, I created a moving average. You can see the gold stays on top all the way through this move up to here. And that's why I use my dynamic moving average, also called my DMA, dynamic moving average, for everything I do. So there's a short and there's a short. And why do I say quotes around that? It's because you can't trade a futures contract on Tesla, for instance. It's a stock, it's not a futures contract. So to go long and short like that, you need a tradable instrument. To trade futures, you need to trade a symbol like ES for the E-mini, or corn, C, or soybeans, S, or cotton, and I don't know the symbol for cotton. So let's put the ES on a chart. The @ sign there in front of ES means it's the continuous contract. So this one does not expire every 3 months. It's a continuous contract. And you can see when the dynamic moving average goes flat, you can see that we're in whipsaw. It's just as clear as day here. Here's another whipsaw period. We're not trending yet. Here's another whipsaw period. You can see price just sits right on top of that DMA for a long time. Futures contracts expire on a regular interval, in fact, every 3 months. And to view the symbol on the charts, you need to know when it expires and use the code for that month and year. So it's a little bit cryptic. Or, of course, when you're testing, you can use the continuous contract. So at the CME side, you can see future symbols. And so Australian dollar symbols AD, and the delivery months or expiration months are H, M, U, and Z. And that's true for an awful lot of futures contracts, H, M, U, Z. And the H, well, I'll get to that in just 1 second. I'll tell you what H means. H means March, U means September, V means October, X is November, and Z is December. So that's how you enter the contract months. So here we can see these contract months. Oh yeah, that's if you go to moneymentor.com and click on reference, you'll be able to see all these symbols there. There's lots and lots of free stuff on moneymentor.com. If you want to go there and just browse around, you'll be surprised at all the things you can find. So the reason behind this is why they expire every 3 months and some more frequently. It's a little bit of a history lesson. Futures used to mean crops and animals. And crops come to market every 3 months, and animals are born and matured every 3 months. So the contracts expired. And it used to be, let's go back, it used to be that farmers would want to take their crops and animals to market every 3 months, but maybe they needed to buy a tractor or a horse to pull a plow. So they could borrow the money against the future delivery of the crops or animals. So that's why they call it futures. They're borrowing against the future and setting the price now. So here are the month codes. And H is March, M is June, U is September, and Z is December for the things I trade. HMUZ right there. So let's look at the ES again. The current expiration month is September. U, since June's already passed, and the year is 2022. So the symbol for the futures contract is ESU22. ES is the contract, U is the expiration month, and 22 is the year. And that's how you construct those symbols. Here's the chart of the ESU22. You can see I've drawn a vertical line and typed rollover in there so you can see when that contract rolled over. I also have it on my calendar so that I automatically know when that's happening. So the exchanges used to physically deliver the commodity to your doorstep, and for some contracts they still do. Imagine a herd of live cattle showing up on your doorstep. I used to dread that. But for others, like the E-mini, they simply cash you out of your position, win or lose, when it expires. Now, you're going to have to remember these dates so that you don't take delivery of something that might have a deliverable. Expiration is the third Friday of the third month of those expiration months. So it's the third Friday of every third month. Rollover is the Thursday of the prior week. So people who trade regularly and know what they're doing, they all roll over their contracts on that Thursday so that they don't expire. And then that's called front month. So on the Thursday of the week prior to the expiration is when you roll over. And all that means is you change your symbol from ESU22 to ESZ22 when we go to the December contract in September. I have it on repeat forever on my phone with an alarm, and then you simply close the contract you're in and buy or sell the next one. So there's the third Friday of June was the 18th. So Thursday the 10th is rollover because it's the Thursday of the week prior. And that's on my calendar for every single expiration. You can see the liquidity in Stocks and Commodities magazine. You can see the liquidity table. It's usually 4 or 5 pages in from the back of the magazine. And this isn't clear, but the E-mini is right at the top with liquidity that goes beyond the width of the page. You can see here it's just greater than symbols. So you can see that that's extreme liquidity. And you don't want to buy something you can't sell. So you do want to trade the most liquid contracts. The 10-year note is usually next in liquidity. The NASDAQ E-mini is all the way down at the 7th. So if you're trading the NASDAQ, you don't have quite the same liquidity. YM, which is the Dow, is down at 19th in this example. So that's why I don't trade either of those contracts. Remember, don't buy something you can't sell. So right there's the E-mini. So how does the E-mini compare to the Dow or the NASDAQ? That's a good question. So you can see with these vertical lines I've marked here, we've got the E-mini on the top, the Dow next, and the NQ. And you can see that these are basically the same shape. They're trading very, very much alike. And you can see the bottoms here. This one isn't quite at the bottom on the Dow, but it caught up 2 days later. When you're trading stocks, you pay the value that's shown on your quote screen. So Google costs, when I made these slides, $29.70 per share. Microsoft costs $336 per share. And unless you have a margin account where you trade on borrowed money, there's no leverage. Futures are leveraged, though, highly. I mean, you're only, to hold an S&P contract, instead of the millions of dollars it's worth, you're only paying, I think the leverage right now is 11,500 for the margin to control millions. Here is a little application I have that shows me, yeah, 11,550 for the overnight margin for the E-mini, and intraday margin is 57.75. So you can control a lot of money with, excuse me, you can control a lot of money with that. Right there's the E-mini. So the E-mini, when I made these slides, was at 37.16. There are 500 stocks in the index, so that's 1,858,000 worth of stock. So for 11,550, you're controlling just under $2 million. So that's just 0.6% that you're putting up. That's better than buying a house, isn't it? That's really steep leverage. To buy a house, you have to put 20% down, and houses out here now cost millions of dollars. So, you know, you got to come up with $200,000 to buy a house, or $11,000 to buy an S&P contract. People do think that since futures are leveraged, you can lose all your money. And since you are so heavily leveraged, yes, you could. You could lose a lot. If you don't have enough money in your account to cover a loss, then you're going to have a margin call. And when that happens, you can lose more money that's in your account, because you have to bring it up to that minimum margin in order to satisfy the account. Otherwise, they'll close your account on you. A broker is going to call you or send you a notice by email that you have a margin call, and you've got to bring it up over the margin rate within 24 hours. So that's wiring money really fast. And if you're sitting on a losing trade, this could, of course, amount to a lot of money. But let's look at how much we can make. The S&P E-mini trades at $12.50 a tick, or $50 per full point. That means if it's trading at 37.16 and it goes to 37.17 and we're long, then we make $50. So next we're going to take a look at, there's a short trade on a stock, and it was 300 points, which is $1,200 in 21 days on $12,000. This is just so you can see the example. And on the ES, that was the December contract of last year, you can see there's the same trade, same time frame. 275 points is all it made, which was 13,750, because it's 275 times 50. So in 21 days, you made 13,000 versus 12,000. So you make more trading that futures contract. Does it ever go to zero? Well, not in the 41 years I've been trading, it hasn't. And then, of course, you say, well, what if the world comes to an end? You're going to have worse problems than that if the world comes to an end. The biggest point drop I've ever experienced was the 1,186 points during the COVID crash. Now, of course, percentage-wise, that's not as bad as the crash of '87. But You got to remember, you can't hold on to a futures trade while you're waiting for it to rebound, which you can with stocks. Why can't you hold it forever? Because it expires every 3 months. What if the rebound takes a year? You know, if you're holding on to Google right now and sitting on a loss, you can just hang on to Google for the next 10 years and it'll probably come back. But you can't do that with a futures contract. They're like options, they expire. They do have trading limits in place to avoid crashes, and you'll see that there's a limit up amount and a limit down amount that are examples of circuit breakers. So if the market moves more than whatever their maximum amount is, it will shut down. And I think it shuts down for 5 minutes first, and then, I don't know, 30 minutes, and then an hour, that kind of thing. So they restrict the amount of rise and drops that can happen. So now that you know that it's risky, I'm going to show you how I trade and have been doing for 41 years. And in fact, I make my strategy available, and I'll teach you exactly how I trade it. It's the same one that made me #1 trader twice. So the first thing I put on any chart, I call them attractors. So they describe all kinds of support and resistance, not only horizontal lines and trend lines, but moving average, where price tends to revert to that average or that horizontal line, which is support or resistance, and to the trend lines. The next thing I put on my chart is my Sunny Bands indicator, and then, and it's based on my dynamic moving average, the golden purple lines at the center of the bands, which avoids whipsaw. So here you can see horizontal lines, and the way I draw them is on, I call it the preponderance of price. You can see an area of congestion here. Up here, we have another area of congestion where price hits it over and over and over again, so I draw a horizontal line there. And down here, we have a low that it hits a couple, 3 times, and there's another horizontal line. And this is the same. It's a 15-minute chart instead of a daily, and you can see how I draw attractors on that chart. So here's how I trade Sunny Bands. And this is a 15-minute chart. So these vertical lines are day breaks, session breaks. So you can see it goes from 7:08 to 7:10. So it goes over the weekend, and then it's 7:11 over here. So you can see the chart as it progresses, and you can see the Sunny Bands where it comes up, it touches the attractor, goes down to the inner band, back up to the inner band, back down to the outer band, up to the DMA, and I trade these signals based on that. The dynamic moving average, the DMA crossover, is my macro clue to everything. So it's the bigger look, if you will. But it's not early enough for me anymore. It used to be when I was trading 15-minute charts, but now on 1 and 5-minute charts, it's not fast enough. So that's why I created my Sunny Bands, which is much faster. And then I created the DMA histogram, which is even more precise. So you can see here, there's the Sunny Bands. Here's price moving up to the outer Sunny Bands. And you can see the histogram on the bottom turns red. That tells me it's time to go short. When it turns green again, that's time to go long. It turns red again. That's gold. And if it turns red again, that's time to go short. And you can see these things happening over and over. I also call Fibonacci lines attractors. You can see how the Fibonacci retracements are hit over and over and over again. And then you can see the DMAH turns here. They're marked with vertical lines on a daily chart so that you can see exactly where I go long and short, long and short. And that's really all that there is to it. I look at the attractors. I do look at Vantage Point every day. It's artificial intelligence software, predictive software that will tell you where it thinks tomorrow is going. So you can always look at tomorrow, and it's on moneymentor.com. If you go there and you scroll down on the home page, you'll see that the latest prediction is always posted on my website. I study the dynamic moving average and the Sunny Bands, and then I trade the E-mini on 1-minute and 5-minute charts. And I do trade many times a day, typically 3 to 5 times a day. With equities, though, I buy and hold for weeks to months, and then I get out when the dynamic moving average and the Sunny Bands tell me that it's about to go down, that's when I exit my stock trades. This is what I do on these two charts. I put two sets of data on the same chart, and then I add a 5-minute chart and put the two sets of sunny bands on there, and it shows me the longer trend, the short-term trend within the longer-term trend, if you want to call 5 minutes long-term. So I do have a YouTube channel that shows you how to put two sets of sunny bands with two data streams on one chart. And there's the YouTube channel, and you can see how to overlay two different time frames on one chart right there. So here's what that looks like. And you can see price comes down and touches the dark green outer, but it doesn't come down to the light green outer band. So I know, because of the 1-minute charts, the dark green, and the 5-minute charts, the light green. So it comes down and touches that. I know it's going up, 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 up. Here it touches both sets of bands. It goes outside of both sets of bands. We're waiting. And there it's blue, turns red, and it goes down within both sets of bands. So you can see those kind of trades over and over and over. It comes down here, touches the 5-minute outer band. We're going back up again. So that's what I watch all day long. We'll just start there. It also works on any time frame. You can see rules for what I do every night. I look at vantage point prediction. I draw attractors on the charts. I put the sunny bands on the charts. I read the signals and take the trades and hopefully make money. You can't be much more disciplined than that. My website is moneymentor.com. It's been active since 1995. Back then, there were only 10,000 users of the internet, and now there are billions. So moneymentor.com is free. If you sign up as a member, which is also free, you can have access to the members only pages in Money Mentor. You'll be amazed how many trading tools and resources are available there, all kinds of information. And I put it there for my own edification, because there are things I want to be able to find quickly, and they're all in the resources page. So please drop by. There's the website. And my products were all developed for my own use in my own trading, but I do make them available to you, and I'll show you exactly how I use them. If you just go to order form, moneymentor.com/order_form, HTML, you can buy anything you want, and I don't hold anything back. There's the order form page. And the special offer I'm bringing to you today is if you order anything before the end of the month, you can get 20% off of all indicators and strategies. Or if you order before the 21st, no, I'm sorry, that should read August 10th. Then you only get 10% off. This even includes my consulting and mentoring time, and I'm expensive, and I am expensive because I'm not only a programmer, I'm a trader. Most programmers and teachers don't trade anymore, and I'm a real life trader. And if you want a free 7-day trial of anything I have, just send me an email, sunny@moneymentor.com, or like I say, give me a call. I'm happy to talk to you. Moneymentor.com is the website. So all my stuff works on any symbol, any time frame, on TradeStation or multi-charts. Here's a special, real special for today. If you wanted to get all three of these, sunny bands, the dynamic moving average histogram, and my PHW dots, which stands for potential hourly wage, it shows you the ideal turning points of every market. It's basically pivot points, but it really helps you in being able to decide how much money is possible to get and whether you're actually getting it or not. So all three of those together, this is the sunny bands. This is the dynamic moving average histogram on the bottom with the sunny bands. And those are the yellow PHW dots that show you where the ideal turning points are. So I have world-class indicators and strategies, trading education, a live trading room for free, access to the members only site, remote installation support, and access to me anytime, any day. So here, if you wanted all three of them together, you can see the standard price. We've got a line drawn through that, and this is 20% off each of those. and that comes to $33.48. But I'm going to give you 20% more off if you buy all three together. So it comes to $26.78 all. That's another 20% off. And that's good until August 10th. Sorry about that date.